Are you starting to feel like your success has become a trap? Like no matter how much you earn, the pressure to protect it only grows? Have you ever noticed that despite your wealth, your financial structure still feels fragile, like you're one market crisis away from chaos? And quietly, have you ever asked yourself, am I building something that could actually survive without me? In this short video, I'm going to show you how high-income earners like you can restructure your wealth the way that institutions do. So you're no longer guessing, no longer exposed, and no longer handcuffed to strategies that only work in fair weather. I'll walk you through how to build a $10 million war chest, a structure that mirrors how elite family offices and endowments preserve liquidity, deploy leverage, and generate tax-efficient growth, so you can build wealth that doesn't need you to survive. Because the truth is this, you've built success, but what you build next will determine whether it lasts. So if you're starting to realize that what you've built might not be enough to protect what you've earned, then it's time to rethink how real wealth is structured. Not how it's earned, how it's engineered. Because here's the truth no one's telling you. The wealthiest operators never liquidate. They leverage. In March 2020, while markets collapsed and portfolios bled, Boeing drew $13.8 billion from bank credit lines. Apple, sitting on $145 billion in cash, issued $17 billion in bonds in 2013 instead of spending reserve. The Rockefeller family office, the Yale Endowment, the Singapore GIC, not one of them sells holdings to fund operations. They operate on a leverage architecture that you've never been offered. Wall Street's business model depends on you never learning it, because every time you liquidate to access capital, trigger taxes, reset compounding, break continuity, they collect fees. That's not a bug. That's the revenue model. Most high-income earners think that wealth is about returns. Institutions know that wealth is about liquidity architecture. There's a difference, and that difference determines whether you're trapped in a portfolio or operating a war chest. Here's what nobody told you when you started building wealth. You don't have a returns problem. You have an architecture problem. And that architecture was designed to make you dependent. You were taught the retail playbook. Earn, save, invest in retirement accounts, lock up capital in real estate, build net worth. Then when you need liquidity, liquidate. Sell holdings, trigger capital gains, reset your compounding clock, start over. Every transaction generates a fee for someone. Every liquidation resets your timeline. That's not wealth architecture. That's revenue engineering for them. Here's how institutions operate. The Rockefellers don't sell JP Morgan shares when they need $50 million. Yale doesn't liquidate venture holdings to fund campus construction. Singapore GIC doesn't dump real estate during market turbulence. They borrow against what they own. They keep assets compounding. They control timing. They access liquidity without breaking their capital engine. Retail investors liquidate. Institutions collateralize. Today, I'm showing you the exit. I work with high-income earners who feel successful on paper, but stuck in practice. I show them how to buy back their time by building capital systems that work like institutions, but for their family. These are families earning between $500,000 a year and $7 million annually who discovered something disturbing. They built exactly what Wall Street told them to build, and now they're trapped inside it. If you're earning between $500,000 a year and $7 million annually, you're on the path to $50 million, $100 million, maybe $500 million net worth. The people ahead of you, the ultra wealthy operating at $100 million plus net worth, they scale. They don't follow the retail playbook. They built different systems, and that architecture gap is what's keeping high earners trapped. Illiquid real estate empires, locked retirement accounts, capital they can't access without triggering tax grenades. The net worth looks impressive, but the liquidity looks catastrophic. So I'm showing them what permanent capital institutions have learned over the past century, over the past 110 years. Liquidity is not about cash sitting idle. Liquidity is about access without liquidation, not through retail advisors pushing managed portfolios, not through Wall Street selling products, through permanent capital architecture. Family offices, university endowments, sovereign wealth funds, Federal Home Loan Banks, central bank facilities, they've engineered systems to access billions in hours without selling a single asset. Berkshire Hathaway maintains $147 billion in float, leveraged capital at near zero cost. Buffett never liquidates core holdings. He borrows against them. And that's what separates institutional operators from retail capital allocators. If you can't access your wealth without liquidating it, you don't control it. If your liquidity depends on market timing, you don't control it. If you need permission to deploy your own capital, you don't own it. Access without liquidation is the definition of institutional wealth. This isn't wealth management. This is extraction from a system that's designed to keep you liquidating. So let's architect the alternative. Here's the stat Wall Street praised that you never calculate. The average high-income earner maintains less than 5 to 10% liquid reserves outside retirement accounts. Everything else is locked up. Real estate equity, the 401k, prisons, illiquid investments, private equity lockups. They trained you to call this wealth building. Institutions would call it capital incarceration. Now, contrast that with the liquidity architecture that institutions deploy. Bank of America, 46.7% liquid reserves against total assets. JP Morgan Chase, 46.8% of strategic liquidity reserves. New York Life, over 60% in collateral-ready capital. When March 2020 hit and markets froze, they weren't liquidating. They were borrowing. They were deploying. They were acquiring because they don't operate on one liquidity source. They operate on 7. Let's pull back the curtain on how institutions stay liquid while everyone else locks up. They don't just rely on one source. They've built 7 institutional funding channels. 7 different ways to access capital without liquidating a single asset. Each one is a lesson in leverage, timing, and control. Let's walk through them. Channel 1, central bank facilities. At the heart of the system sits the Federal Reserve. This is the ultimate liquidity backstop, what institutions call the discount window, the standing repo facility, the bank term funding program. Here's how it works. Institutions pledge U.S. securities, agency mortgage bonds, or investment-grade corporate debt. They receive cash same day at policy rates. Back in 2008, Bear Stearns faced a repo run. Overnight funding stopped. Liquidity just completely vanished. They went from solvent to shut down. The Fed's response? They backstopped $30 billion overnight through JP Morgan. They created a new lending facility in less than 24 hours. Central bank liquidity doesn't freeze, it expands. Channel 2, the Federal Home Loan Bank system. Now, just one layer out from the Fed sits a quieter but just as powerful engine, the FHLB. It's a government-sponsored lending network. It's used by banks, insurers, financial institutions. They can pledge mortgages, mortgage-backed securities, even business loans, and they can draw advances same day or next at just above Fed policy rates. MedLife, they borrowed over $15 billion through the FHLB. Life insurers, they held $137 billion in these advances by 2022. Not for emergencies, for arbitrage. Borrow at 1.5%, deploy at 3.5%. Pocket the spread. And the kicker? These lines never froze. Not in '08, not during COVID. Institutions with FHLB access kept moving while everyone else panicked. Channel 3, the repo markets. This is the circulatory system of the institutional liquidity. It's called the repo market. Institutions pledge securities, usually treasuries, agency bonds, or corporates, and they receive overnight cash, rolling daily. In normal times, over $1 trillion moves through repo markets every single day. Even in 2008, when bilateral repo froze, tri-party repo backed by clearing banks kept flowing. The timing? They trade in the afternoon, cash arrives by morning. If this is connecting, I've put together a private briefing at warchestprinciple.com. It breaks this all down and it shows you how to mirror it. Channel 4, securities lending and prime brokerage. Institutions don't just sit on their assets, they lend them to hedge funds to market makers to generate liquidity. In return, they get cash collateral. And then their prime brokers offer margin loans, typically at 1 to 3% interest, against the exact same portfolios. This is how family offices and ultra-wealthy individuals stay liquid without triggering a single taxable event. Own $50 million in Apple's stock, borrow $35 million at 2.5%, never sell, never pay capital gains. That borrowed capital gets deployed into real estate, acquisitions, or new ventures, while the Apple stock continues to keep compounding. That's two assets working at once. Channel 5, syndicated credit facilities. See, now we're stepping into corporate territory. Companies like Boeing, Apple, and Amazon, they don't wait for a crisis. They pre-negotiate multi-billion-dollar credit lines with bank syndicates. These lines sit ready, unused, untouched, until needed. In March 2020, corporations drew $240 billion in 1 week. That's twice a normal year's volume. Boeing alone pulled $13.8 billion in 72 hours when COVID grounded aviation. Not because they were broke, but because credit lines give you optionality. Channel 6, the commercial paper markets. This is short-term funding at scale. Top-rated companies issue commercial paper unsecured notes that last 30 to 270 days. The cost, often less than treasury bills. Same-day funding, instant liquidity. And when these markets freeze, like they did in 2008 or March 2020, the Fed steps in and guarantees the system. Institutions use this channel every single day. Retail investors, never even seen it. Channel 7, the corporate bond markets. Now we move to long-term capital, permanent money. In 2013, Apple had $145 billion in cash and still issued $17 billion in bonds. Why? Because borrowing at 2.4% was cheaper than repatriating cash and paying 35% in taxes. In 2020, when Boeing was facing collapse, they issued $25 billion in investment-grade bonds, one of the largest offerings in history. No asset sales, no panic liquidations. They leveraged through the crisis. Now, before we move to your personal balance sheet, I need to clarify something. I just walked you through 7 institutional liquidity channels: central banks, Federal Home Loan Bank, repo markets, securities lending, syndicated credit, commercial paper, and corporate bonds. But that's not what I'm telling you to build. You're not Boeing. You're not Yale. You don't need the 7-channel liquidity system that institutions use. What you do need is to understand how liquidity actually works at the institutional level. Because once you see the pattern, once you see how the largest wealth operators in the world structure access without liquidation, you can mirror the doctrine without all that complexity. Every one of those 7 channels operates on the same principle: borrow against assets, never interrupt compounding. That principle, you can install it into your life without replicating 7 funding channels or, again, institutional level complexity. So here's what I'm about to show you, is how to take institutional liquidity doctrine and simplify it into a personal architecture that works for families like yours, not Fortune 500 balance sheets. So here's the bottom line on institutional doctrine. If you've got a pen, this is the one you write down. Institutions don't liquidate to access capital. They collateralize and they never interrupt compounding. Their assets keep working. Their loan costs, 2 to 4%. The spread, that's their profit. This isn't theory. This is how every major institution in America operates. The Rockefeller family office maintains collateral-ready reserves. The Yale endowment, it holds 20 to 30% in strategic liquidity reserves. Borrowing at 2 to 4%, deploying at 8 to 12, whether you're at $3 million today or $30 million tomorrow, the principles don't change. The Rockefellers built dynasty wealth over 6 generations. Yale endowment has compounded for over 300 years. Singapore's GIC manages $700 billion. These aren't anomalies. They're models. The spread is the strategy. Institutions don't pick between liquidity and growth. They build architecture that give them both. And now so can you. Now let's shift from the institutional level, the way that banks and endowments build liquidity, to your personal balance sheet. Because the same logic that lets Boeing draw $13.8 billion in 72 hours, it can be engineered into your life as well. It's a 4-layer personal liquidity architecture. It's a framework designed to give you access to capital without ever interrupting compounding. Now, before I walk you through these 4 layers, I want to be crystal clear about something. Institutions operate on 7 liquidity channels. You don't need 7 channels. You need the advantage that those channels create. What you need is a system that gives you the same institutional advantage, access without liquidation, without the machinery and all the overhead and all that complexity. Layers 1 through 4, yeah, these are tools. These are real tools, tools that work. Securities backed lines, HELOCs, business credit facilities, relationship banking capital. If you've got the net worth, the business revenue, the real estate equity, these layers can absolutely serve you. But there's a 5th layer that I'm going to show you in a moment. And that 5th layer, it's the foundation. It's the layer that turns a stack of tools into an actual liquidity architecture. So let's walk through each layer together. Layer 1. Securities-backed lines of credit. If you hold $2 million in stocks, bonds, or ETFs, you can establish a securities-backed line of credit, what institutions call an SBLOC. It usually gives you access to 50 to 70% of the portfolio's value. That's roughly $1 to $1.4 million in available liquidity. Interest rates range from 1 to 3%, tracking the Fed funds rate plus a small spread. You can let interest capitalize, or you can service it from cash flow. There's no credit check, no income verification, no taxable event. You access capital without selling a single share, and the portfolio keeps compounding quietly in the background. This is how ultra-high net worth families deploy liquidity for acquisitions, real estate, business opportunities, all while holding appreciated positions indefinitely. They follow a rhythm that you may have heard of before. Buy, borrow, die. They never trigger capital gains. They pass assets to heirs with a stepped up basis. Liquidity without liquidation. Layer 2, home equity lines of credit. If you own real estate with significant equity, a home equity line of credit, a HELOC, can turn that equity into standby cash. Here's what it typically looks like. You can borrow up to 80 to 90% of the value on your primary residence. You pay interest only during the draw period. Rates usually range from 4 to 7% depending on credit and market conditions. And once approved, you can access the funds in as little as 2 to 4 weeks. That means the equity in your home, which most people treat as locked and illiquid, can become a ready-to-deploy reserve when opportunity or crisis strikes. Institutions call this collateral optimization. You can just call it smart architecture. Layer 3, if you own or operate a business with $1 million or more in annual revenue, you already qualify for the 3rd layer. This is where you begin treating your business like a miniature institution. You can establish revolving credit facilities, essentially smaller versions of the syndicated loans that corporations use. You can set up asset-based lending against receivables, inventory, or equipment. You can even secure commercial real estate lines against income-producing property. Interest rates usually fall between 4 and 8%, depending on your collateral and performance. But once approved, those lines sit ready. Pre-positioned capital that works just like Boeing's $13.8 billion facility, but sized for your operation. That's not Wall Street finance. That's institutional logic applied to your own enterprise. And layer number 4, relationship banking capital. This 4th layer is the one that most high-income earners never really think about. It isn't a product, it's actually a relationship. In March 2020, companies with deep relationship banking ties received credit approvals 2 to 3 times faster than transactional borrowers. That's what I call the trust premium. If your operating accounts, business deposits, and treasury management all sit with one institution, you're not just a customer. You're a relationship. And relationships get calls returned during crisis. They get credit lines approved when markets freeze. Institutions value partnerships that last decades because liquidity flows through that kind of trust. So when you combine these 4 layers, the securities-backed line, the HELOC, the business credit facility, and relationship banking capital, you create a liquidity architecture that mirrors what institutions have used for more than a century. Each layer adds stability. Each layer adds capacity, and together they give you access without liquidation. The single greatest financial advantage the wealthy have ever engineered. Let's talk about what I call the war chest liquidity doctrine. Most people maintain a single liquidity source. Maybe it's a savings account or a brokerage. But real financial architects, they engineer 4 layers of liquidity. And there's a 5th that gets revealed at just the right moment. They don't wait for a crisis to figure out where their cash is going to come from. They pre-position credit lines before the storm hits, when markets are calm. They don't cash out appreciating assets when opportunity strikes, borrow against those assets so they can access capital without interrupting compounding. Borrow against appreciating assets, never interrupt compounding. That's not traditional wealth management. That's institutional treasury strategy scaled to your personal balance sheet. Now, let me show you what this actually looks like in practice. Here's what this looks like before restructuring. This is what I call the retail architecture. It's the way that most people unknowingly position their net worth. So let's say that somebody has $3.2 million in net worth. It's spread across 5 categories. 1, $800,000 in 401ks and IRAs, which are locked up until age 59 and a half. Touch them early, and you'll get hit with penalties and taxes. 2, $1.4 million in real estate equity, maybe 15 rental properties, each leveraged at 70 to 80%. 3, $600,000 in a taxable brokerage account, but selling triggers capital gains taxes north of 20%. 4, $150,000 in business equity, but there's no buyer waiting for it. It's illiquid. And finally, $250,000 sitting in a checking or savings account. That's the only truly liquid capital that they have. So let's pause there. Even though they have $3.2 million on paper, they only have $250,000 in deployable cash. That's just 7.8% of their net worth in liquid form. Now let's look at a real world situation. Their daughter needs $200,000 for a medical treatment overseas. At the same time, a trusted business partner offers them a $500,000 equity stake in a company at a steep discount, but they've only got 72 hours to say yes or no. What are their options? Well, option 1, sell from the brokerage account, but that would trigger over $120,000 in capital gains taxes. Option 2, sell a rental property. That could take up to 4 to 6 months, and it depends on market conditions. Option 3, withdraw from the 401k. But with the 10% early withdrawal penalty plus income taxes, they'd lose more than $75,000 just to access the money. So what do all 3 of these options have in common? They destroy compounding. They trigger taxes. They break momentum. That's not liquidity. That's forced liquidation. Now, let's look at the same $3.2 million, but this time restructured using the war chest architecture. Here's how it's built. Layer 1, securities-backed line of credit. We take the $600,000 in the brokerage account and use it to establish a securities-backed line of credit. This opens up 70% of that value, or $420,000 in available liquidity. It's accessible at 2.5% interest. No taxes, no selling. The portfolio keeps compounding the entire time. This is how the wealthy access capital without interrupting growth. Layer 2, strategic liquidity reserves. Next, we reposition $400,000 into what I call a private strategic liquidity reserve. This is a private liquidity instrument, something that most retail investors never even hear about. It gives you $320,000 in available capital. That's 80% of the value at an interest rate of about 5.5%. This becomes your quiet reserve, sitting ready, invisible on the surface, but highly potent when you call on it. Layer 3, we tap into the equity of a primary residence. Let's say we establish a home equity line of credit, or HELOC, for $300,000. This converts previously illiquid real estate equity into standby cash. It's interest only during the draw period. You can typically access it within 2 to 4 weeks, and it carries a rate of about 6.5%. You're not selling the home. You're simply unlocking the capital that's sitting inside of it. Layer number 4. Then we establish a business revolving credit facility. Let's say for $150,000, backed by receivables. This operates just like the corporate credit lines that we talked about earlier, just scaled to a personal business. The rate could be around 7%. The capital sits pre-approved, waiting for activation. Now you've added liquidity to the operating side of your life, layer 5. And finally, through deep relationship banking, you receive a $500,000 term loan. It's already underwritten. It's already pre-approved. This isn't about credit scores or forms. This is actually about trust, because in times of panic, relationships move money faster than algorithms. So let's pull this all together. Total accessible liquidity, $1.69 million. Percentage of net worth, 52.8%, up from 7.8. Average blended borrowing cost, around 4.8%. Let's go back to the two situations that we looked at earlier. Scenario 1, daughter's medical treatment. They need $200,000 fast. They simply draw it from the securities-backed line of credit at 2.5%. Total interest, $5,000 a year. Meanwhile, their portfolio is still compounding at 8 to 10%. So they're not just preserving their gains, they're earning the spread up to 5.5% net while deploying capital. No taxes, no sales, no break in momentum. Scenario 2, the $500,000 business opportunity. To fund the deal, they draw $300,000 from the HELOC and $200,000 from the business line of credit. The deal is closed in under 48 hours. If that equity position returns 15% per year, that's $75,000 in annual upside. Total interest cost, $24,000. Net annual gain, $51,000 plus equity appreciation. And when the time comes to transfer wealth, whether through estate planning, trust execution, or generational handoff, there's no panic. There's no fire sale. There's no rushing to free up cash. You simply execute the architecture that you built 20 years earlier. Wealth isn't what you own. It's what you control. So what is the war chest doctrine? When crisis hits, medical emergency, market crash, liquidity crunch, you don't panic. You deploy pre-positioned capital. When opportunity strikes, distressed real estate deal, equity stake, acquisition, you don't wait for liquidity. You execute in 48 to 72 hours. When markets collapse and portfolios bleed, you don't liquidate at losses. You borrow at 3% and buy. That's not portfolio management. That's war chest operations. You might be thinking, this sounds complex, man. Like, why don't more people do this? Because Wall Street makes more money when you don't. Every time you liquidate, capital gains taxes anywhere between 15 to 20% in state plus federal. There are advisory fees on new positions, 5 to 1.5%. Transaction costs, bid-ask spreads. You reset your compounding timeline. The total destruction is anywhere between 20 to 30% of deployed capital. Every time you borrow against collateral, the interest cost could be 2 to 6%. Zero taxes, zero advisory fees. The capital keeps compounding. The net advantage, 15 to 25% preserved. Wall Street's business model is liquidation. Institutions' business model is leverage. The Rockefeller family has operated across 6 generations on this doctrine, building from legacy family office operations into today's multi-generational wealth management platform. Yale Endowment has compounded for 308 years without liquidating core holdings. Bridgewater, Ray Dalio's hedge fund, maintains 30% plus in liquid reserves. He's never forced to sell in a downturn. He's never trapped by illiquidity. Singapore GIC, which manages $700 billion and borrows strategically for deployment, they're not smarter. They've just built different systems. And now you know the blueprint. I'm Christopher Hemmer, founder of the War Chest Principle. After working with high-income earners who felt trapped by their own success, I realized they didn't need more hustle. They needed a system that bought back their time and kept working even when they didn't. Now here's the layer that completes your personal liquidity architecture. This is the piece that Wall Street never taught you, because teaching you this breaks their revenue model. I just walked you through 4 liquidity layers: securities-backed lines, HELOCs, business credit facilities, relationship banking capital. All of them work. All of them give you access to capital without liquidating assets. But here's the truth that institutions have understood for generations. Tools alone don't create certainty. Architecture does. And here's what I've built my entire system on. I don't want liquidity that's likely to be there when I need it. I want liquidity that's contractually guaranteed to be there. Regardless of the economy, the markets, or a bank's risk committee. That's why I build on cash value life insurance. Not because it's the only tool, because it's the only tool that satisfies all 4 laws in every environment. It lets me access capital without selling a single asset. It lets me borrow while the cash value continues to compound. And it isn't tied to Wall Street or any of Wall Street's mood swings. And it holds its value in a crash, even when everything else gets punched in the mouth. I'm not interested in banking relationships that might hold. I'm not interested in credit lines that might stay open. I'm interested in certainty. And that's exactly what this layer gives me. So let's break this down. On screen, you're looking at the 5 main liquidity tools that we've walked through in this video, side by side, scored against the 4 laws of true liquidity. These aren't theories. These are the laws that institutions already follow. And the first question that they ask is simple. Can I access this capital without selling an asset? Because if you have to sell, trigger taxes, or get penalized just to touch your own money, that's not true liquidity. That's liquidation dressed up like a strategy. The second law, does this keep compounding while I borrow against it? If accessing your money stops its growth, it's not true liquidity. It's a reset button. The third law, is this tied to the stock market? Because if your emergency capital crashes when the market crashes, you don't have a safety net. You just have a bunch of exposure. And the fourth law, does this hold its value in a crisis? I'm telling you, institutions don't gamble with reserves. They fortify them. Now, when you line up every tool against these 4 laws, SBLOCs, HELOCs, business credit, relationship banking, here's what you see. Most tools check 1 box, some check 2, maybe 3 if conditions are perfect, but only 1 hits all 4 every time. And that's why I build my system on cash value life insurance, not because it's trendy and not because it's clever, because it's the only financial instrument that gives me the luxury, the leverage, and the contractual certainty to act no matter what's happening in the market. When opportunity shows up, I don't want to wait for approvals. Do you? I don't want to hope that my banker still has an appetite for risk. I don't want to ask for permission. I want to deploy immediately while my capital keeps compounding in the background. Other options exist for sure. Lines of credit, relationship banking, business liquidity, they're likely to work. But I'm not building my family's financial future on likely. And if I could be so bold, neither should you. That's why this final layer isn't just the 5th layer of liquidity. It's the one that holds the entire system together. So let's talk about what this actually looks like operationally. You're not building wealth to stay at $5 million or $10 million. You're architecting for $50 million, $100 million, maybe even $500 million or more. And the same liquidity architecture that serves you at 5 will serve you at 500 because structure scales. So let me walk you through it step by step. Step 1, audit your liquidity architecture. We call it your true liquidity ratio. And here's how you calculate it. You start by identifying how much capital you can access without selling an asset, triggering taxes, taking a penalty, or waiting longer than 7 days. If you can't reach it quickly, privately, and without interrupting compounding, it doesn't count. Then you divide that number by your total net worth. If you're below 30%, you're still operating on retail architecture. Institutions target 40 to 60% in true accessible, non-correlated, leverageable liquidity. Step 2, establish your personal liquidity architecture. That means opening 5 distinct channels: a securities-backed line of credit if you have a taxable brokerage, a HELOC on your primary residence if there's equity available, a strategic liquidity reserve, aka your war chest, business credit facility if you operate a company, and relationship banking capital by consolidating deposits and treasury operations with one institution. That's not just diversification. That's structural redundancy. Step 3, reposition capital strategically. This isn't overnight. Think 24 to 36 months. You're rewiring the system, not flipping a switch. If you're 100% in illiquid real estate, shift towards 60% real estate, 40% liquid reserves. If you're locked in traditional retirement accounts, consider Roth conversions and strategic liquidity reserves that can be accessed before 59.5. If you've got 0 pre-positioned credit, build toward $500,000 to $2 million plus in standby liquidity. Over time, you want your reserves not just sitting, but growing, compounding, and ready to be leveraged. Step 4, deploy the stack, shield, scale framework. This is the rhythm institutions use to build scalable, multi-generational wealth. Here's what it means. Stack. Redirect your income into a stable, liquid, compounding reserve. This becomes your war chest. It grows uninterrupted and it passes the 4 laws of true liquidity. Shield. Borrow against your war chest to acquire income-producing assets. No selling, no shrinking. Your reserve keeps compounding while the leverage does the work. Scale. Reinvest returns, tax savings, investment profits, and cash flow. First, refill your reserve, then expand again with zero dependence on new earned income. You don't need more effort. You need better architecture. Institutions leverage. Retail liquidates. Choose your side. That's the war chest principle. That's how institutions operate, and that's how you extract yourself from the Wall Street dependency trap. If you want to go deeper, I've put together a private briefing at warchestprinciple.com. It shows you how institutions build wealth that outlives them and how you can do the same. You'll also get a free PDF showing you how the wealthy think about income taxes and time and how you can use them like tools, not traps. So let's land the plane. Wealth is not your net worth. Wealth is accessible capital under your control. If your wealth is locked inside retirement accounts you can't touch for 20 years, that's not liquidity. That's a pension. If your wealth is trapped in real estate that you can't access without selling, that's not architecture. That's immobility. If your wealth requires Wall Street's permission to move, that's not freedom. That's dependency. Institutions figured this out in 1913 when the Federal Reserve was created, and they've been using it for over 110 years. Wall Street kept you liquidating because that's how they got paid. Today, you saw the exit. The question is, will you keep building the retail way? Or will you start architecting like an institution? The war chest framework, stack, shield, scale, gives you the blueprint. The research is available. The mechanisms are documented. The only variable is whether you choose to deploy them. You've earned your income. Now it's time to earn your freedom by thinking the way institutions do, by building a system that works without you, and by protecting the one thing you can never earn back, your time. If this hits home, subscribe. This channel's small for now, but not for long. I only teach what the wealthiest families and institutions actually do, because they've figured out what works, and I think you deserve the same. Keep building for the generations you won't meet until you meet in heaven. God bless.